6. Difference between fixed deposits and mutual funds. A mutual fund is an investment scheme provided by the asset management companies that enables investors to pool their money together into one professionally managed investment. Mutual funds invest in stocks, bonds, cash, or a combination of those assets. Fixed deposit (FD) is an investment scheme offered by banks where the investors can deposit money for a fixed tenure and for an agreed rate of interest. Let us now look at 6 key differences between fixed deposit and mutual fund. Return. FD rates are agreed upon before opting for an FD. The investor already know beforehand what their returns are going to be over the tenure of their investments. Whereas, mutual fund returns are affected by market conditions, hence an investor could stand to gain more if market conditions are favorable, or could earn considerably less if conditions are not favorable. Risk. Fixed deposits are almost low-risk investments. Since the rate of interest does not vary on fixed deposits during the tenure of the investment, investors are guaranteed a fixed return on their investment. Mutual funds are risky investments. An investor could stand to make negative returns if the markets move in the opposite direction. Ability to beat inflation. FD is not an inflation-beating instrument. We all know that inflation eats a major chunk of our savings in terms of loss in the value of money. So you need to keep pace with inflation. Your investments would be worthy only if they are able to offer you decent inflation-adjusted returns. Assume you have invested in a fixed deposit offering interest 7% per annum while the rate of inflation is 5%. Your inflation-adjusted return would be only 2%. It is quite obvious that you would like to look beyond this rate. Mutual funds have the ability to offer you better inflation-adjusted returns in the long run. But please remember that they come with a relatively higher risk. Tax treatment. Interest earned on fixed deposit is fully taxable in the hands of the depositor as per his tax slab. The tax treatment on mutual fund is not so straightforward. In case of equity-based mutual fund, if the investor makes a long-term capital gain, that is, where the holding period is more than 12 months of more than ₹1 lakh, then he would be taxed at 10% on the excess amount of ₹1 lakh. If the investor makes a short-term capital gain, that is, the holding period is less than 12 months, then he would be taxed at a flat rate of 15%. Costs. Investors investing in fixed deposits do not incur any expenses since no intermediaries are required to handle the investment process. Whereas mutual funds come with certain costs or expenses in the form of fees paid to fund managers who take care of an investor's portfolio. Liquid fund may have a low expense of up to 1% per annum. Debt mutual funds may have anywhere between 0.5% per annum to 2.25% per annum, and the expense of equity mutual funds may be up to 3% per annum. Protection. Bank fixed deposits are protected under Deposit Insurance and Credit Guarantee Corporation up to a limit of ₹1 lakh in case of bank default. Mutual funds, unlike bank FDs, do not come with any insurance. So to sum up: return, risk, ability to beat inflation, tax treatment, costs, protection. The decision to invest between a FD and a mutual fund is based on a plethora of distinguished funds. But when the economy shows brighter prospects with corporate profits on an upswing, it is advisable to invest in the mutual fund as return from bank FD tends to go down.